All right, how's everybody doing out there in social media land? You are here because you want to learn about money, about investing. It all comes together, just making better financial decisions. We talk about the stock market a lot, but it's also about financial planning, which we talk about, charitable giving. We talk about oil stocks as a sector, technology, you name it, we talk about it. And especially the hot money topics, like when everybody was getting all bulled up on crypto or SPACs. We talked about this stuff. And I have to say, just a little pat in the back here, how I panned the some of the exchange traded funds, these new funds. Like one was titled, the symbol is meme for meme stocks, MEME, and SPACs, SPAK. Like I panned the crap out of these things. I thought that they were just simply to take advantage of people's enthusiasm and greed button without really giving people a chance to think. And I was like, you know what, these are going to be a disaster. And I was 100% correct. And it's a reason why you could watch the show here, because you learn these little tidbits of knowledge along the way. And I don't want to stretch out like a 30-minute Shakespearean soliloquy all about one particular ETF and really just try to fill up the airtime here. I want to give you knowledge. And if I talk about 20 subjects in 20 minutes, I'm happy, and I hope you are too. The idea is not to go on and on about something, it's about to share knowledge with you. And sometimes things just pop into my head, like something that just popped into my head now. And it's worthy of its own title for the show. Dividend cuts are on the way. Because if we're going into a profits recession, and companies like FedEx, which just announced earnings, their earnings and revenues were a good deal below where they were a year ago. And this is happening in a lot of companies. What do they do when we go into a recession? Especially when you hear about this term profits recession, what do companies do? They cut the dividend. So all these people are buying stocks for the dividends. If you're not really careful about looking at what their earnings are compared to the dividend, if you're not looking at the dividend coverage ratio, you're making a mistake. In my opinion, you are making a huge mistake, because when you pay up for a stock that's only up because of the dividend and that company cuts the stock dividend, the stock goes down. If there's nothing else to hold on to, that stock is down and out for a long time. We talked about AT&T a long time ago, and I said to you, I think AT&T cannot keep that dividend. I think they have to cut it. It's all over the place, and I got some flack for it. But eventually AT&T cut the dividend, the stock got crushed, and it's never seen the light of day ever since. That's a reason to watch the show, right? Just sometimes it's not knowing what to do; it's knowing what to avoid. I think there are a lot more things to avoid than there are things to invest in. So I like to focus on both, but a lot of the things to avoid are things that you might be surprised at. So we'll talk about these things. Let's roll the quick intro. Got a good show for you today. Good show here for you today, and I really hope you'll give us a chance to teach you, to educate you. That's what the show is. It's not an infomercial. It's educational content. It's financial. I have lots of really great guests on the show, and I'm going to have a lot more. So, what else? Let's roll the intro. And if you don't mind, whether if you're watching in the live or in the replay, give us a thumbs up. If you have any questions, please ask in the comments. I love hearing from you. It is the best part of doing this. When you ask your question in the comments, I put the question on the screen, and then we get to talk about it. It's the best part of doing this. So if you have any questions or just words of wisdom, or if you just want to say hi, or just write in the comments where you're watching from, that would be cool. Put your favorite emoji in the comments, because also comments help with engagement. And all the algorithms of all the social media platforms will take the live stream, and they'll start to push it out to more and more people when there are more comments in it. So that would always be cool. All right. If you don't mind, one of these, a question or a hello or something in the comments. Now I'm going to roll the intro, and we're going to move through this. Here we go. All right, I see a few people out there watching Thank you so much. And just for a little housekeeping, I have a radio show that starts January 23rd, Monday the 23rd. And similar to this, it's a live show, but more of a morning update, getting ready for the financial day, but also financial education and talking about things that people want to know about. It's going to be out to hundreds of thousands of people covering Long Island, and I'm really looking forward to it. And it's live, so it's one thing to do a live broadcast, but this is definitely a lot more people. But I'm also going to stream it right here on Facebook, LinkedIn, YouTube, and Twitter. So, you all can see the radio show, or just put me on your Bluetooth in the car, or just hit your open up your app, put the show on, and just put it aside, just listen to it. And while you're listening, hopefully you learn something new. Maybe I'll crack a couple of dad jokes and entertain you. And maybe you'll have a question you want to ask me in the comments, or send me a DM or an email or something. And we're going to have a lot of fun, but you're going to learn a lot. It's not an infomercial, as I like to say. It's financial education. And to me, it's all about giving you value. And if I put value into the world, and you are looking for a new financial advisor, a new service provider, hopefully you'll think of me and you'll give me a shot to have a conversation with you about that. No obligations. That's a big part of what we do here. Okay. And if you want, follow me on all of these social media platforms. I'm on them all. I'm very active. I think the easiest one to navigate is Instagram. And if you just want to quickly find every little tidbit of solid advice, information, or say education that I put out there, go to Instagram. And I basically post on Instagram, 4 or 5 snippet videos from my live stream per week. I post them all over social media, but I think they're really easy to find on Facebook. I mean, on Instagram. Facebook gets a little bit crowded. LinkedIn is a little bit crowded, I find, but Instagram is just easy to organize. You go into someone's profile, you see what they post. And since I'm not as active on Instagram, it's actually easier to find my content. So if you want, follow me there at InstaMitchG. All right, so we're talking about dividend cuts. And I think a real concern is that when we go into a recession, as some people say if, so let's say if we go into a recession, my view is we may already be there. I've been saying this for a while, and it doesn't show up in the stats yet, but I think the beginning is showing up. And if we have a recession, obviously stocks, we typically go down. Actually, let me go back. I think stocks actually start to stabilize and even go up when it's finally acknowledged that we are in a recession. But while we are anticipating one, stocks trade lower, because if we go into a recession, you have to take corporate earnings estimates lower because the economy is slower. Generally speaking, slower economy means weaker earnings. And, stocks go down when that happens, until we finally say the Fed's ready to start cutting rates, and then the market goes up and later earnings go up. Earnings are a lagging indicator, just so you know. So while earnings go down, a lot of investors are very complacent right now. And let me explain that, because I'm not trying to insult my viewers here. Okay, I'm not trying to insult you. What I'm trying to say is, everyone has this thought that the Fed is going to make its last interest rate hike, and then it's going to pivot, and we're at the end of interest rate hikes. Inflation has peaked, and the Fed's going to stop raising rates and even cut rates soon after that. And I think that's a little too optimistic. Bear markets are very messy affairs. And if you look at the major averages this year, let's say the S&P 500 is off about 20% on the year. Now, mind you can't invest directly into an index, but you could invest in a security that tracks or mimics an index, okay? But while the S&P is down, it's not a disaster. Now, there are many individual stocks that are down 70, 80% or more. But the S&P down 20% year to date is not a disaster. We've seen these kinds of drawdowns before, and it's weird how people are getting all worked up about it, like it can't happen, it shouldn't happen. Or if the Fed raises rates, we're going to go into recession. Oh, no, we're going to go into a recession. We always go into recessions, and then we come out of them. Going into recession is not something, as far as your investments go, should scare you. Because even if you're retired or close to retirement, the money you need for financial obligations in the next year or two, you could even say 3 years, that's out of the market anyway. That should be in cash. So a down market wouldn't affect you. Now, if you're all invested in all stocks, maybe you're too heavy in technology, you're feeling a lot of pain. But shame on you. I have to say, shame on you if you are close to retirement or in retirement and you've done that. That one's on you. I mean, it's like you. I highly doubt you're working with a financial advisor, because a financial advisor would have you prepared for these markets. I know what you're thinking, but look, a financial advisor is not here to guide you into the market for good markets and out of the market for bad markets. If that's what you expect from your financial advisor, you really need a fortune teller or someone who can read a crystal ball or a tarot card reader or something. Okay, that's not what a financial advisor does. A good financial advisor will completely agree with what I'm saying. A financial advisor is supposed to help you create an investment portfolio that you could stick with through both bull and bear markets, that you won't panic out of. That's what a financial advisor does. It's one of the things a financial advisor does. So this way, when the market goes down, you don't panic out. And when the market recovers, you're in the market to enjoy potentially positive returns. Just so you know, bull markets go up a lot more percentage-wise than the percentage that bear markets go down, which is why the stock market over the long term has had an upward trajectory. The other thing a financial advisor does is to help you plan, to help you get ready for the future events. A good financial advisor will know what's coming for you, what's next in your life. Like, I'm not saying that I know where you're going to dinner on Saturday night. Like, I can't tell you if you're going to get hit by the proverbial bus or not. But based on your age and your situation, I can tell what's next in your life in terms of college planning, wedding planning, you name it, retirement planning, job switch. By talking to you, I can figure out what's next for you. Not just what's next for you, but for the 2 or 3 things that's next for you after what's next, and get you prepared for those financially. Get you prepared for a disability. Get you prepared if you become laid off from your job. Get you prepared if you sell your business for a whole lot of money. Get you prepared for what comes next. Where does the money go? What do you invest the money in to sustain you after your income has disappeared? Because now you have to use your assets to replace your income, which is a completely different mindset and investing job as compared to helping you accumulate money so you could get to the point of retiring, of using your assets to replace your income. They're completely different. So a good financial advisor will know how to flip that switch for you and get you ready for it. There's so many things, a financial plan. They're just, should you buy, should you lease, should you rent, should you own? So many things that a financial advisor could do for you, and you should utilize us if you don't have one. All right. If you're a DIYer, fine, good for you. I don't knock you. I'm happy to share the knowledge, because I believe the more I put into the universe, the more that's going to come back to me. So I was explaining to my son and my daughter, my nephew, a couple nights ago. I was saying to them that when you help somebody, don't think in terms of what that person can do for you or not. Just know that if you help somebody, it's going to come back to you, but it might not come back to you from the person you helped. It could come back from somebody else. But the point is, it'll come back to you. So just help people, help them, and it'll come back to you. It might be from different people, but it does come back to you. It's the way the universe works. I'm a huge believer in that. That's that. So what else are we talking about? Let's do a quick market update. All right, let's get you ready for the market update. And I have 3 stocks of the day. I know we like the 3 stocks of the day. So the 3 stocks of the day are FedEx, Nike, and Tesla. And we're going to take a look at those right now. So let's do the stocks of the day. The first one is Tesla. Let me put it up on the screen, okay? You see that 52-week low? Tesla down another $12 today, down 8%. Tesla's just been getting absolutely crushed, but it's at a year low. It's given up more than half of its market cap. The amount of money that the stock has gone down by, like, probably $800 or $900 billion in market cap is bigger than every single company with the exception of the top 3 or 4 companies in the S&P 500. That's what they lost in terms of market value. Okay, market cap and market value is the same thing, just so you know. All right, but the stock is down 60% year to date, and finally, reality I feel like is catching up to them. You had a CEO who's hyper distracted by his acquisition of Twitter, which I still can't believe that happened. And then you've got a CEO, who's putting out polls and stuff. Now he put out a poll that asked people on Twitter, should I or should I not be CEO of the company? Most people said no. He was already actively seeking a full-time CEO, so it wasn't as much of a deal for him to leave the CEO job as you think. You probably think he's already looking for a new CEO. But in this case, I don't agree with the pundits. I agree with the Twitter users. Who better to ask your company's users of your product, your product, the users of your product, to see what could be your next move? Look, I know for me, when I want to make a change in my business, introduce a new program or something, I poll my clients. I ask them, is this something you could use? I am pitched all the time for, certain kinds of mutual funds, certain kinds of charitable accounts, real estate investment trusts, alternative investments, you name it. I'm all the stuff is thrown at me. Ways to manage money, and you know what? You have to have a good filter. But when it comes to the way I manage someone's account, I actually want to ask the clients, the end user, is this something you'd be interested in? Would this make your life better? Would this add value in your eyes to the job I do for you? And many, many times, most people just say, no, I could care less if you did that for me. I think, we're looking to reinvent the wheel, but really it's just still about good service and listening to people, what they need, what they want. My job is not about positive or negative returns. If somebody says something to me like, well, you're a financial advisor, shouldn't your accounts be up, or should you be making money for people, or what if you're not making money for people? That's not what a financial advisor does. Again, we're not fortune tellers. We're supposed to we're supposed to help you invest according to your risk tolerance and time horizon, which you'd be amazed. It's easy to say those things, but very difficult to figure out those things. We help you get there. Okay. A lot of things we do. We already talked about that. So Tesla, stock of the day. If I was a Tesla owner, I would be just so upset with Elon Musk for being distracted by Twitter while Tesla stock just falls apart. The next one is FedEx. Let's pop this up on the screen. FedEx earnings sink as soft demand persists. Let's see how FedEx is doing in aftermarket trading. Okay. FedEx is up $6. Investors have overlooked the fact that their revenues are down a good amount from a year ago. FedEx is announcing cost cutting. Again, if enough companies cut costs and think there's a recession and get ready for a recession, that alone is enough to cause the recession. It's like a self-fulfilling prophecy. However, investors like what they heard in terms of margins for FedEx, in terms of grounding old jets, closing sites, and overall a massive cost-cutting measures that they'll be taking. And, so nothing new in terms of the earnings, but the stock was down about $4 or $5. After market trading, it's turned around to be up $6. And the last one is Nike, which is up $10. All right. So up $10 between FedEx and Nike. That's enough to get the market to move up if these aftermarket gains hold up. But to see Nike up almost 10%, that's enough to shoot the Dow up tomorrow, because the Dow barely moved today. So let's take a look at how the major averages did. Dow up a measly 92 points after a couple days in a row of being down a lot. NASDAQ up a whopping 1 point. That's not 1%. Okay, that's just 1 point. S&P up less than 4 points. This is barely a recovery, which just goes to show how negative investors are. But what I don't get, or I should say I get it, but it's odd. You see the VIX? Okay. See this? The VIX right here? The VIX you would expect to be up to like 30 based on how bad the market's done the last couple of weeks. But the VIX is staying nice and low. And what does the VIX do? The volatility index, basically, it's a measure of fear. It's when professional investors become more fearful, they start to pay up for protecting their portfolios for derivatives. And you would normally see the VIX go up in that case. But the VIX has stayed in the low 20s for a long time. It's not moving up. So either somebody's complacent or the VIX is telling us that the market's going to be okay over the next 12 months. That's what the VIX is telling us. It's really tough to say who's right and who's wrong. Now, if you're getting ready for a bear market, okay, the idea is not to just bail out and say I'm just going to go to cash or something. It's make sure you have a portfolio that you're comfortable with to ride out the storm. Okay, and that's what you're going to have to do. You're going to have to ride out the storm. I know a lot of people are like, well, if you think there's a bear market, why don't you just get out and buy back lower? We don't know when the bear market hits. We don't know, or we should say, we don't know when it goes lower. We don't know when a recession hits. We have our projections. Now, I've told clients, I don't want you betting your future on my hunches or not. I don't go by hunches. I have my hunches. It gives me a starting point to do some research. And sometimes I change my hunch. Sometimes it reinforces my hunch. But ultimately, I'm still investing on your behalf. You have to be invested on your time horizon, your goals, your risk tolerance. That doesn't change. And then you have so many other plans. Now, a down market, by the way, is your friend if you're still accumulating assets. So we talk about a down market like it's so bad. It doesn't faze me at all. Just up markets and down markets have come and gone since markets have been invented. I've been doing this for 32 years. I've seen plenty of down markets and miserable years. You get through it. I mean, it's just don't speculate. Now, if you're in stocks that you are speculating in, like that, that are down 80, 90% since their peaks, then I would be worried. I'd be like, can those stocks ever recover? You have to take them on a case-by-case basis. Without naming names, I'm going to say no, they're never going to recover. But that's why I like to get into stocks that a branch manager once said to me, make sure when you get into a stock that you've heard of it, that your clients are familiar with. That's generally the blue chip type companies. Not everything has to be blue chips, but I've seen so many investors lose on stocks that were hot or they thought could be a blue chip. I don't know. I do know. Maybe I'm just not saying it so great. So who's out there? James Martinez. Hey, thank you so much, James. Peaks and valleys. You are correct. Peaks and valleys. But the good thing is the new peaks are always higher than the last peaks, and the valleys are never as low as the last valley. So that's why the market is jaggedy over the short term, but the trend is up over the long term. All right, we've got a few more minutes left. So let's just take a look at the bond market. All right. My other screen is right there. That's why I keep looking over here. But the bond market yields were up pretty much once you get to the 2-year bond. Okay, let me put this up on the screen. All right. Yields were up 2 years and up. Japan had a surprise move. Just so you know, 90% of all central banks in the world have raised rates. This is the biggest rate hike globally that we've ever seen in history. And it's remarkable how well the market is held up. And the stocks that got killed are the usual suspects. We talked about these, the overvalued stocks, which just become interest rate plays, the stuff we avoided, from the SPACs to the pandemic stocks. And here we are. So interest rates up a little bit. They're just basically getting to where they were about a week ago. Nothing has really changed much. And does anybody still look at crypto? Bitcoin's still under 17,000. I don't really look at the whole crypto universe. I just look at Bitcoin. I just want to say about Bitcoin, all right, there are something like, 20,000 cryptos and more are coming out all the time. We have no idea which one of those cryptos are going to be the one. There's a really good chance that all the cryptos you've heard of, from Bitcoin to Ethereum to Litecoin, there's a really good chance that all of those just disappear and a new crop of bigger, better, more useful cryptos appear that we start to use. And what happened with FTX, the crypto exchange and account holder, really put such a it just crushed the confidence. Uh, it just crushed the confidence of investors that their money is in a safe place. It's hard to trust anybody these days, and FTX certainly reinforced that. So that is what's going on in the world of finance. We're going to talk more about this as the days go on. Last thing is for 2023, what's going to work for next year? And I'm seeing all the analyst projections come out. Some are pushing Facebook for next year. Some are pushing tech in general for next year. I saw one analyst push advanced micro devices, and another big semiconductor, Broadcom. And another analyst, I think JP Morgan, is pushing Amazon as a top pick for next year. All of these are probably going to be wrong. So invest according to you. You do you, and let the analysts do themselves their way. And you might not even be suitable for individual stocks. I find that most people are suitable for individual stocks while we're in a bull market. Then you go into a bear market and they scratch their head saying, how the hell did this happen? And that's why I like invest. I do with a lot of investors who are experienced, who've been through a couple of cycles, and they know themselves so much better that they're much easier to work with. When I work with a new investor who sees all his or her friends making all this money on some individual stocks, it's very hard to talk them off the ledge, because it's intoxicating to them to see that they can make money so quick in a stock that keeps going up, and they buy it, they sell it, they jump into another one, they hear about another one, and they think they're really good at it until they come crashing down. And usually what causes them to crash down are interest rate hikes from the Federal Reserve. That's what always ends the party, right? All right. So that's my story. I'm sticking to it. I am so appreciative that you took the time to watch. If you have any questions that you think of after this or during, of course, hit me up in the comments. A couple of likes would always be appreciated. You can catch me in any of these social media channels: Instagram, YouTube, LinkedIn, Facebook, and Twitter. I want to thank my amazing producer and editor, Natalie Cantwell, for doing such a great job in all of my videos and video snippets. And that is about it for the day. I'll be back tomorrow. Have a good night.